The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box. Here are your headlines today. Chinese trade data returns to growth in April, topping expectations and signalling an improvement in demand both at home and overseas. ARM shares sink almost 9% in extended trade as the chip designer issues a disappointing revenue forecast, fueling fears of a slowdown in AI demand.
President Biden issuing his strongest warning yet to Israel, saying the U.S. will withhold weaponry if the IDF pushes ahead with an invasion of Rafah. And the Bank of England getting set to deliver its latest rate decision, with the market split on the chances of a first rate cut. Not this month, I'm afraid, but next month. We're going to bring you my conversation with the Governor, Andrew Bailey, at 4 p.m. London time. Good morning, Karen Jo. How are you?
Very well, thank you. You?
Yeah, I'm all right. I've got a very interesting day.
It's a slow day ahead for you, isn't it?
I spent the last 3 hours of my evening yesterday just pouring through old Bank of England statements as well, and it was fascinating.
Well, there's one thing we know, right?
What's that?
You're not going to get a rate cut today.
Oh, do you know? Just
putting it out there.
On the tiniest of chances. Why don't I go a bit left field?
Yeah.
There is a sequence of events that could happen. I'll talk you through it later. Where it could it won't happen. I know you're right.
Right.
But you never know. I think June is fascinating. Can't wait for that one. But we've got good news this morning out of China. So let's get to this because Sam's waiting in the wings. Chinese exports grew by 1.5% in April, whilst imports rose by 8.4%. Beating analysts' expectations and suggesting domestic demand is slowly coming back in the world's second largest economy. Well, look, we've got Sam coming up to talk all things China in a few moments' time. But let me just put this in a global context. Sam will talk about what it means for China. Imports rose by 8.4% as well. What happens, and this is an eternal question, what happens when the Chinese economy is motoring on all cylinders? Does it A, mean that actually we're going to see a resumption of an export of deflation globally, or does it mean actually the resource demand that the Chinese will suck in as well means a resumption of inflationary pressures? I know it's not the only aspect, and it's certainly not what Sam needs to cover as well, but isn't that fascinating that we're all going to start thinking, if China suddenly, the behemoth that it is, starts going again, what does that mean for global demand?
It's a great point. I'll pick up on the export of deflation story because we heard from a big logistics company yesterday talking about all the e-commerce products coming out of China that has been shipped to the world or sent out as air freight, and effectively telling us very cheap goods catching traction with Western consumers and beyond at this point because of the cost of living crisis that we're facing. We also know that the Chinese are going after market share in new economies. So it's all different touch points when it comes to some of that Chinese export material that we're talking about.
Sam is there, and she's been poring over the data, which on the surface to us, Sam, looks pretty good, but you're going to dig into it for us. Good morning.
Very good morning to you, Steve and Karen. So we've seen a return to growth with the Chinese and exports and imports improving last month, and certainly on the import side it was a surprise to the upside, so signs of stabilisation, but of course it's just 1 month of data, so we should perhaps sort of manage our expectations moving forward. But let's talk about those exports, as you guys were just talking about sort of the global implications. What is happening here? At a headline, it does look good. There were some certainly bullish views coming from the global investment banks as to what this number might look like, and then some sort of more pessimistic, you could say, views coming from the economists over at Peking University. But this came in line with the expectations. If you look under the hood, though, a few concerning trends here. We know that exporters have been actually slashing their prices in order to continue to maintain these customers outside of China, given the uncertain economic picture at home. Now, of course, the yuan plays into that, given some of the depreciation pressure that we've seen. But this really becomes a story actually of volumes versus value, because the value keeps sort of going down, but the volumes have been at those record highs. Particularly, that's what we saw in March. So that is telling us that perhaps the margins are being squeezed at some of these companies. And we put that to an economist in Street Signs Asia Time, and we were talking to them about how some of the smaller companies might actually suffer as a result of this. Then you've got the overcapacity story, which, of course, President Xi Jinping was pushed on over in your neck of the woods this week with regards to some of the concerns around trade imbalances, EV protectionism. He doesn't believe that there's an overcapacity problem over in China, although just today we're seeing that they're very much cracking down on the lithium battery market to address some of this. But then the imports very much speaks to perhaps the stockpiling we're seeing going on right now, bringing in some of those cheaper commodities before the prices go up. And that very much speaks to China's industrial priorities right now, guys, with President Xi Jinping's new productive forces right now. So there are a few things going on when you look under the hood. Back to you.
Sam, thank you very much for the details. Sam Vardas with us there. Let's get to Duncan Wrigley. Here is the chief China economist at Pantheon Macroeconomics. A lot to pour through with you, Duncan. Let's just start broad. We know that China is aiming towards this 5% growth target for this year. As you start to see the numbers now rolling across imports and exports, is it telling you that domestic demand, international demand is going to help support China's endeavours to get to that 5% target?
Yeah, for sure. The recovery is starting to firm. It's broadening out a bit. But I would say still that, frankly, domestic output, industrial production is growing faster than domestic demand. Even with a bit of improvement in domestic demand, the very weak property sector remains a big drag on the economy.
The other big feature this week has been the negotiations, discussions behind the scenes with major European players, from France first up to Serbia and Hungary for President Xi. What are the aims and ambitions here for the Chinese? What's resting on these conversations that Xi's having?
The EU is conducting an anti-dumping investigation into the imports of very, potentially very low-cost Chinese electric vehicles. If you look at the retail prices of electric vehicles, the same models of electric vehicles in China, they're 1/3 or 1/2 of the current prices in Europe. So there's potential for big price cuts, which haven't happened so far. But the EU is very worried that China has this massive competitiveness in this very key industrial sector. So I think behind the scenes, there are some negotiations to try and manage that.
Duncan, I want to go back to the point you were making about domestic demand. You and Karen have been talking about the international situation, the import-export, which looks more optimistic. Is there anything that the Chinese authorities can do or will do that are going to meaningfully galvanise domestic demand? I had the most wonderful conversation with Richard Koo in Ambrosetti earlier this year, where he transferred his hypothesis about balance sheet recession over Japan in the 90s to China now. I thought it fitted beautifully.
Yeah, so the Chinese government is doing something, but it's fairly targeted and small. There are these policies to encourage trade-ins of cars, old cars, appliances, also industrial equipment. And that is meaningful. It's going to probably drive 1 to 2 million extra car sales this year. So that's something, but it doesn't make up the huge gap. Now, the big kind of fundamental reforms that would be required to really shift China from this kind of industrial-led economy to a consumer-led economy, I think they're going to, if they happen in China, they're going to be over the medium term. We'll see signs if that's really going to happen at the third plenum in July, which has been announced. That is where they traditionally discuss these kind of big reforms. It could involve, population controls, land reforms. Those are the kind of things that could unleash a next wave of urbanization and consumption growth in China.
Excellent. Why don't you have a stab at this other question? Is China going to be, again, it's one of those eternal questions, historically has exported deflation. And with what you were saying about EVs and they're highly competitive finished goods, totally, I get that. That will be more deflation. But on the other side of the ledger, by sucking in more raw materials, critical minerals, energy, etc., Will China be creating inflation on the other side of the ledger if its economy starts motoring on all cylinders?
I don't think that's going to happen this year. I would characterize the economy as motoring on, let's say, 3 out of 4 cylinders, if we're going to use that analogy, because, again, the property sector is a massive, massive drag. We did see in today's trade data a big jump in import commodities such as iron ore, copper, soybeans, but it's from a sort of fairly low base. I think domestic demand is going to pick up, but it's not going to be the same strength as we've seen in some previous commodity cycles, such as after the global financial crisis. So, yes, picking up, but, the speed is still not there to really drive global inflation.
And as we get a stronger read on imports today, let me just ask you a little bit about the Chinese consumer. We know there's been a long shadow cast from the property market woes, the impact that can have on some of the animal spirits that we've seen from recent years by consumers. And we've seen it in the luxury numbers in Europe, where there's been a slower pace reported by some of the major companies on those spending patterns. What sort of health do you think Chinese consumers in? And do you think they're still going to be displaying the same sort of firepower that they have in the past?
Yeah, so the Chinese consumers really took a big body blow during the extended COVID restrictions. Last year, when things reopened, people did come out again. If you look at things like activity flows, the number of tourists has rebounded quite strongly over the recently passed Labor Day festival, up almost 30% above 2019 levels in sheer numbers. But where things are lagging is in spending. That's way behind. And also between holidays, people aren't spending so much between holiday seasons. Reasons for that: labor market is still quite weak. For example, the construction sector lost about 9 million migrant workers between 2022 and 2023. That's how much the jobs fell, largely because of the property sector. People are finding new jobs elsewhere, services, driving Uber, like the equivalent of Uber in China. But that still, although there's some recovery in the labor market, it still remains fairly weak. And property market, people are still just about regaining confidence in the future, but it is way below, where it was when consumption was really booming. So I think there's still some way to go in the consumer recovery.
Duncan, thank you very much for joining us to run us through the Chinese markets on the back of the data today. Duncan Wrigley with us, Chief China Economist, Pantheon Macroeconomics.
So, BBVA, its second stab in the last few years for Sabadell, rejected out of hand as undervaluing the Bank of Sabadell. We've now got a lot of details just hitting the wires on that BBVA bid, but they've said previously they're not going to improve it. Last week, as I'm sure our viewers will know who've been following this story, they were offering one newly issued BBVA share for every 4.83 Sabadell shares. That is a 30% premium to the closing price of the Sabadell before the bid. And everything I'm looking at that's hitting the wires now is just a reiteration of that as well. So it's the offer just going public pretty much as well. Consideration is offering one newly issued share for each 4.83 ordinary shares of the company. So that is the original offer. This does not look like any form of improvement. I'm pretty much sure we're at a logjam now where BBVA said they won't improve. Sabadell said they won't accept. So this is perhaps going straight to the shareholders. The decision to launch the offer was adopted by a resolution approved by the offerer's board of directors at a meeting held on the 8th, which was yesterday. So going public with the offering as well, very difficult to see how this one can go ahead without the board of Sabadell accepting the offer.
Yeah, we were told that there was no more room to move from BBVA. That was the message that came loud and clear, and they're effectively saying, look, the share price of Sabadell had moved from mid-April. So because they had to take that into consideration, you effectively saw a lot of the firepower used up. And when the bid was made, the offer was made, a 48% premium to where Sabadell shares stood in mid-April. So I think it is telling you the market reaction has also been that investors were concerned that BBVA could overpay. The share price lost about 6 billion euros worth of market cap. So the share price in retreat on the back of this offer. And as a result of reading the tea leaves for the M&A side, a lot of the traders thinking that this wouldn't go through, BBVA share price rebound. So it is telling you almost that traders are voting with their feet as to how they think this one should go.
It didn't rebound that much, did it? I don't think. It was quite a small
It
single-digit
did move.
moves, weren't they?
It has moved.
Can we get the BBVA and Sabadell share prices up, actually? I thought they were quite moderate moves yesterday. Have you got yesterday's moves? It'd be very interesting. But my point is here is they want 50.01% of acceptance at the of the share roster as well. 99% of the shares, I've just been having a bit of a look, 99.95 actually is free float. So there's a lot of big investors out there. And I'll just go through the list of the top investors. You've got BlackRock at number 1 with 6%, Capital Research Global Partners at 4.85%, then Capital International, Norge Bank, who we speak to as well, 3%, Vanguard at 3%. So the big names are all there as well. So it'd be very interesting that this is an appeal to those shareholders as well.
I've got to say, it's disappointing for BBVA through the context that one of the real trends has been to retreat to home market and bulk up in home market. And the reality is that without CMU and banking union, the ability to grow your business cross-border in Europe is not there at this stage. But having a large market share in your own market is considered a good thing by a lot of the analysts, a lot of the investors in Europe.
At the moment,
yes, and not all banks have that. If you look at some of the German banks, very low market share because of the amount of competition. In Spain, we're getting to the position where there's a very large market share by the likes of Santander and BBVA is consolidating even more. I think that would have been a fascinating backdrop for Spain, and perhaps it might change the way analysts and investors would have viewed the Spanish banking market.
I mean, the only thing I will add to this as well is that given our history of looking at bids, who goes in with your best offer first time round? I mean, whether you're buying a car or whether you're buying a company, nobody necessarily goes in with your best bid or best offer straight away. And for BBVA to go in with this 4.83 newly issued shares per big part, one new issue shared for every 4.83 Sabadell shares, for going in with this as well and saying there's no room for a better bid as well. What kind of statement? I kind of wonder what the negotiators, you go in with one, you have a chat and you say, okay, we can improve that, we can slightly up the ratio, but they haven't. They've gone in and said, this is it. Boom, and I can't see it's given much room for negotiation.
This was the problem, that there was that rally, and whether it was something in the backdrop and discussion or whether it was the market revaluing Sabadell on numbers, you did get a movement in the share price from mid-April. So that was what the BBVA board was alluding to, that it really made it quite difficult. I mean, if you look at the year-to-date performance, who would expect that a bank in Spain would deliver a 56% year-to-date performance? I mean, who would think that was possible, right?
We were saying the same thing about Intesa and UniCredit just now. On that note, we had a brilliant interview with Carlo Messina, the CEO of Intesa Sanpaolo, yesterday. Just have a look at his comments if you can find it online. I'm sure our wonderful.com team have done this, about cross-border consolidation and what needs to happen in Europe as well. This is one of the great men of European banking making comments, which were quite scathing, really, about the broader atmosphere for cross-border, which alludes to the point you made.
We got that message in Davos from a whole bunch of banking CEOs, didn't we? That's how we kicked off 2024. Well, coming up on the show, ARM shares decline in extended trade after a lackluster revenue guidance disappoints investors. We'll discuss more. Plus, all eyes on Threadneedle Street. Attention turns to the Bank of England and its commentary on the future rate path ahead of its decision later today. You see Steve down there, say hi to him. We're going to discuss more later this hour. Earnings season continues in Europe. We'll be speaking to the CFO of Telefonica later on the show. Tune into that exclusive interview, 8:30 CET.
Listen to CNBC's Beyond the Valley, the podcast that explores the biggest tech news from across the globe. Join me, Arjun Karpal.
And me, Tom Chitty, every week as we bring you insights into the top stories, unpack the latest trends, and find out where the industry is headed.
Now available on Spotify, Apple Music, and Google Podcasts.
Do you remember the old, you don't remember this, do you? From the, I think it's like the 30s or 40s, the old Robin Hood series. Robin Hood,
not the original one.
No? Rod does. He's about 100 years old.
I've watched a lot of Robin Hood movies, though. It's one of my favourite genres.
Yeah, but you like the constant big hair look, don't you, with Christian Slater?
I just love the whole series, but I've been to Sherwood Forest. I don't think many people can say that.
Oh, well done.
Yeah.
Were there outlaws?
No.
But they're
It was actually
gorgeous
it was somewhat-
outlaws in flowing locks in green tights.
It was really underwhelming. So,
I know.
you go to a lot of American
Yeah, I know
tourist
Nottingham pretty well,
attractions,
yeah.
and they're amazing. There's a lot of theatre.
Yeah,
You turn up
yeah.
to Sherwood Forest, and
Yeah.
there's pretty much nothing
Well,
there
that's the
except an
same
old
as-
tree that's been propped up so it doesn't fall down.
Well, that's the same
There was
as
an
my
ice cream
forest,
stall.
which I live in the Ashdown forest,
Right.
and you get all these tourists come down and
Yeah.
trying to find Winnie the
Winnie the
Pooh,
Pooh,
like all the
yes.
attractions. And
No
like,
one's found him
we
yet.
don't have any. There is Pooh Bridge, but that's another issue. Anyway, Robinhood the stock, jumped over 4% in extended trade after posting record quarterly revenue and net profit that also topped Wall Street expectations. The earnings beat comes on the robust performance of the online's brokerage crypto business. The company reported net income of $157 million or 18 cents per share, whilst revenue rose 40% to $618 million year over year. We've got a whole segment planned here, and rudely, Rod, you've released Telefonica numbers.
Yeah, our producer Mike's getting
Personally.
really excited about the numbers too. So let's get into them. The Q1 net profit, 532 million euros. That is up 78.9% year over year. Adjusted EBITDA, 3.21 billion euros, up 1.9% year over year. So that's quite a slim line on the adjusted EBITDA. Revenue has climbed less than 1%. It is up 0.9% to 10.14 billion in the first quarter. So the numbers telling you results on track to meet 2024 guidance. It is also saying its 24 dividend is 0.30 euros per share to be paid in cash. But I think that revenue line is quite interesting, and the EBITDA line telling you about some of the challenges still in the industry. And as you know, fresh from a big industry conference earlier in the year when it's on stage with the CEO of Telefonica telling me that the industry dynamics do not stack up and calls for further consolidation as the industry gets ready for AI and all new data challenges.
Spoke to the Deutsche Telekom bosses, Tim Höttges as well.
Yes.
And you know, if we talked about the need for consolidation in the banking sector, the telecoms industry would bite their arm off to get a slice of the growth that the banking sector's got. I mean, the performance of the banking sector this year is far better than the performance of the telecom sector over the last 10, 15, 20 years. And this is, can I give you a case in point? This is a stock. I've just looked at Telefonica. It's trading pretty much the same level it was trading 4 or 5 years ago. And you can go back years as well. It's got a 7% yield, and yet it still can't attract. And the reason, two reasons. One, they're struggling to monetize all these amazing trends. Two, and well, part of that is the growth figure you just mentioned. Was it up 1.9% EBITDA year on year? The revenue figure was just underwhelming. What, 0.9%, was it?
And free cash outflow of 41 million euros.
Well, that's a problem. That could be problematic for the dividend going forward as well.
But you're right to compare banks to telecommunications. This came up in the letter report, one of the three industries that was flagged where you need some
This is
more
Enrico
help,
letter,
more intervention.
galvanising European business.
Yeah, roll back of some of the regulation, more consolidation. So that was definitely one of the areas where there was some concern.
And the British case in point is when Vodafone tries to do a major tie-up, it gets referred to the regulator for an in-depth investigation.
Yeah.
What else is coming up?
We are going to be talking to the company itself. We'll be hearing to the Telefonica CFO, Laura Abasolo, at 8:30 the CET. That is exclusive on CNBC. Now, ARM shares fell in extended trade after the chip designer issued guidance that missed expectations. The US-listed firm forecast full-year revenue of between $3.8 and $4.1 billion. The company beat fourth quarter expectations with a near 50% jump in revenue. Don't miss that interview with the ARM CEO, Rene Haas. That is coming up at 1500 CET.
Can we do this one a little bit? Just because I know we got other stories.
We are going to come back to it, I believe.
Are we?
Just going to give you a quick line.
Why are we doing Nvidia first?
Well, just going to give you a quick line on their view because there was a link between the two. Despite the negative sentiment, Nvidia CEO Jensen Huang has struck a bullish tone on the chip maker.
I love ARM then. I love ARM to this day. And everybody now realize what a great franchise it is. And so anyways, hey, look, it would still be a great franchise inside NVIDIA. I'm still putting a pitch out there. I'm just kidding. But it's a great company. I love working with them, and they're great for the world.
So, what's the problem with ARM?
There isn't a problem.
There is one problem.
A quarter? The quarter was a problem?
No, they were great. They were great. But the problem is the stock price. It's the same old story, isn't it? How do you value this stuff? What did you just say the revenue figure was? You just said something about the revenue figure. Was it 4 billion? Let me have a look at your read.
3.8 and
I'm
4.1
gonna be
billion
generous. I'll
for
call it-
full-year revenue is what is now seen.
Full year revenue, circa 4 billion, yeah? Mm-hmm. Well, have a look at
Midpoint 3.95.
What does the market think this company's worth? It thinks it's worth 109 billion US dollars on a 4 billion annual revenue. Now, the 4 billion annual revenue sounds pretty good to me, but then how many fours go into 109? 22. So you're basically talking 22 times forward-looking sales on this company. Well, when you used to buy, when all our brilliant viewers or M&A viewers out there, you know, they'd like to try and, if they really can buy it on the cheap, they'll try and buy something at 3 times sales, maybe 5, maybe 7, maybe 9 times sales if it's really good, not 22 times sales. So in an area where the M&A guys wouldn't touch this one as well, and they have a great slide rule as well, you're asking people to buy a company which has relatively stable revenues rather than exponential growth like Nvidia. You're asking them to pay 22 times sales for a company that is growing, that's got brilliant revenues, that has got a dominant position in various of its chips and the V9 royalties, etc., etc. You're asking our viewers, investors, to pay something that a lot of the professionals wouldn't touch.
Right. Let's just go back over what the company does, though, and you can make a judgment as to whether you think it's going to be relevant in the future. And don't forget, the sell-off we've seen in the stock really was around some of the very conservative guidance that the company was getting based on when the licensing orders would fall. So it gets licensing fees for the semiconductor design.
Yeah, it clips the ticket.
Right. And those semiconductors are mostly in phones at this point. Do we think phones are going to be required in future, particularly with AI? Pretty sure we're going to want new phones. Pretty sure we may need new semiconductor designs as well. So we can tick that box. Collects a royalty for every chip sold that uses its technology. Think there's going to be a few chips sold. If you look at what everyone's done with Nvidia, pretty sure there's going to be a few chips sold down the track. And don't forget, it's not just all going to be in these data centers where there is a huge focus right now. It's going to be other areas as well, thanks to the AI story. But, you know, ARM is not cutting itself out of data centers as well. It's going after some of that business where it has not been a huge player in the past. So I'm not sure we should write it off. I think you just got a little bit of bumpiness around the quarter.
Yeah, it's a great company. And I do appreciate, by the way, I was judging the sales on 1 year's sales, and people obviously want to extrapolate a longer model on the sales forecast because of the longevity of the product and the excitement out of the growth.
Which is a timeline we can't see at this point. We don't know what those orders are going to be, when they're going to fall, how much they're going to be. Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to cnbc.com or join us again on the show with me, Steve Sedgwick, and Karen Cho, weekdays on CNBC.